Over the weekend, Treasury Secretary Janet Yellen said higher gas prices do remain a risk out there. Joining us now is former Federal Reserve Vice Chair Roger Ferguson. It's great to have you back on the show, Roger. Is there any number that could come out tomorrow on inflation that would alter the course for the Fed at next week's meeting?
You know what? I really don't think so. There's a hope that the headline CPI number will come in a little lower. Surveys of economists show a number that comes from 8.5 to 8. The core, which came in the last time around 5.8, might move up and down a few tenths. But I don't think there's any number that's really going to move them off of the currently market expected and I think likely 75 basis point move in September.
Sure, but inflation expectations really have come down, Roger. If you look at some of the break-evens and the swaps, do you think that inflation will come down rapidly from here?
I don't think it's going to come down rapidly from here for a couple of reasons. One is something that Secretary Yellen talked about, which is there's always a risk of a surprise that drives commodity prices, particularly oil, back up. Secondly, labor markets continue to be very tight. The most recent reading shows, again, roughly 2 job openings for every unemployed person. Yes, the labor force picked up in terms of size just a little bit, but all those seem to me like, improvements moving in the right direction, but only modestly so. So I don't see anything that's a fundamental break in the fact that inflation is much too high. And the final point to make is the level of inflation, even if it comes down a bit, is still quite a bit above the Fed's stated 2% goal.
So you think the market's still getting too excited about a pause early next year in rate hikes?
I think the market may be being a little too optimistic about a pause next year. The Fed officials, starting with the very top, have been clear that they expect to go maybe a little higher than the market expects, and to stay there a little longer. And so I think it's premature for the market to start pricing in a pause. The other thing I think the market has got to take on board is Chair Powell's statement that he really does want to see growth come in below trend for a period of time. And so even a slowing, which would have perhaps in the past signaled the Fed pivoting towards an ease, I think is not necessarily a precursor towards an immediate pause or turning towards ease in the first part of next year.
The counter-argument, Roger, is that the Fed isn't paying close attention to all the indications that inflation is coming down, from the commodity market to shipping rates to supply chains easing overseas to some of these numbers like China wholesale inflation coming down, and that's happening at a time where growth is slowing, and where, as you know, there's a lag from tighter monetary policy. So really what might be more appropriate is for the Fed to either pause or cut back on its jumbo-size rate hikes.
That might be more appropriate, but the other side is the Fed has said clearly that they want to see clear and convincing evidence of inflation, not just coming down somewhat from these high levels, but really coming down enough to give them comfort about the 2% target. So I think the disconnect may well be the Fed's clear intention to get the inflation rate much closer to 2%, while the market is simply saying, well, a little breather from these astronomically high levels is acceptable. So I think there's a disconnect there. The other slight disconnect may well be that the market thinks any slowing is a signal that the Fed is done. I think the Fed believes that a slowing below trend for a period of time is a sign that they have perhaps achieved their goal, but not that they then want to quickly reverse. They've learned the lessons of stop-start, and I think they really are trying to avoid that.